Well, I know a lot of you here in the room, but my name's Steve Scoggan. I'm a CPA with CLA. We're a national CPA firm. I think we just found out last year that we're the number 1 construction accounting firm in the country. We have about 130 offices throughout the country and about $1 billion in revenue, and all that's great. But what we really have, and one thing that I was a part of a small local group called the Leverage Group here in Salt Lake, and we joined CLA about 3 years ago. And we were heavily into construction at that time, and so is CLA. So construction is a difficult business to be in, as you already probably know, but it's even more complex in terms of taxes, and that time is coming up here shortly. And I've been doing this a long time with contractors, and it's we always think about, well, what are your biggest expenses as a contractor? Well, probably your first is labor, I would think. Materials might be in there, but if you're making money, which I hope you are, taxes are one of the biggest expenses you might have also. And we all know how much time we spend managing our labor and our people and trying to find people and trying to keep people. How much time do you really spend in terms of taxes and saving taxes and planning for taxes? Just something that I always like to emphasize. Again, the contractors that are successful are the ones that really spend a lot of energy on this type of thing. Now, you don't have to know the tax code, but it is always good to have someone that does, or someone that knows contractors and can help them save a lot of money and plan for the future. So, so I'm going to talk a little bit about taxes tonight, but I also, before I get started, I brought with me one thing CLA does is we do an annual benchmarking report for our contractors, and basically about, I think it's 750 contractors throughout the country, we do some sort of reviewed or audited or compiled financial statements. And we take all those financial statements and we put them into a benchmark report, which kind of talks about everything from, what your G&A, what percentage of your revenue should your G&A expenses be, what type of return you should make on your equity, what kind of backlog that you have. And we basically take these 750 contractors and put it all into different subcontractor categories and come up with this great report. And if you want a copy of this came out last summer. We actually are putting one together here as we do financial statements for 2019. But if you want a copy of it, just shoot me an email, and the email is on the last slide. And those of you that are here have a copy of it. Send me an email and I'll get you a copy of this. It's very interesting. And contractors ask me, how much should my G&A, how much should my overhead be? And to be honest with you, it ranges anywhere from 6% to 16% of your revenue. So if you want a benchmark, it would be somewhere in that range. Now, it obviously depends on how you account for things, and some people put more costs into direct costs than overhead, but it shouldn't be more than 15% of your revenue. So something to be thinking about as a potential slowdown might be coming. I don't know. I keep asking people whether or not they're slowing down, and people don't seem to be slowing down here in Utah in terms of construction activity. There's a lot of big projects still out there, and it's very interesting to hear that people are busy through 2020 into 2021. Even some of the contractors I work with are busy through 2022. So with all these big projects, keeping the big guys busy, hopefully there's going to be enough work for at least the next 1 to 2 years, is as far as my crystal ball goes. But so things are good, and things have been good for a long time, but we're always waiting for that shoe to drop. and certainly hope it's not going to be as big of a bang as it was in 2007, 2008, 2009. That was really painful for all of us, and hopefully that's not coming. But again, one of the things that we all should be paying attention to is keeping our eye on the ball and being aware and watching, some of these leading indicators, like, what are the architects and engineers and how busy are they? And they're still pretty busy. So that means there should be a lot of projects in the pipeline still. But just something to keep in mind. And if you want a copy of this benchmark report, just shoot me an email and I'll send you a copy of it. But okay, we're going to be talking about everybody's favorite. Whoops. Is it on?
Yeah.
It's on?
There we go.
There we go. You can go one more. And go one more, Dave. Thanks. Let's see. There we go. All right, I'm live now. Well, yeah, so taxes. There was big tax law changes in 2018, at the end of 2018, or the end of 2017. And we had a whole lot of questions last year at this time in terms of how things were going to play out. Well, most of those things have played out, and we have a pretty good handle on how things are. Bottom line is, this was the biggest tax law change since Ronald Reagan, if not even before that. So, and especially there were some huge benefits and huge planning opportunities for contractors. So I'm going to talk a little bit about that tonight. A lot of this stuff is a repetition from last year, but we understand things a lot more now. And again, whatever was good last year with these new tax law changes is still good now. And I'd like to talk a little bit about some of these fundamentals. So really, as contractors, there are really only a few big things that we can do, okay, to get tax deductions to save taxes. Number one is depreciation, is buying stuff, okay? Contractors need stuff to do their work, most of them. They may not need Mastercraft boats or snow machines, but they need assets, they need machines to do their work. And depreciation is the big one. The second one, which I won't talk about much today, but is really a profit sharing or 401k or self-employed pension or defined benefit plan or whatever you want to call them. But we're all having trouble finding and keeping good people. And if we could come up with some ideas for you to set aside, as I assume most of you are owners of your construction company, set aside a large amount of money for yourself, as well as some for your employees, and get a tax deduction now, that's kind of a no-brainer. And we talk to our clients a lot about all the different plans that are available, and there's ways to get hundreds of thousands of dollars for the owners compared to a much smaller amount for the employees. And it is enough that many contractors still don't have even a 401k. So it's a competitive advantage to have that. And with the tax savings you can provide the employees with a huge benefit just with the tax savings, and set aside money for yourself as the owner. I mean, who wouldn't do that? So I'm not going to talk about a lot of details, but that's probably the second big tax deduction or tax savings that's available now. The third one, which I'll also get into here in a little bit, is tax method changes and how you can show your income differently on your tax returns than you do on your books, okay? I mean, it's always the tightrope walking that I need to do with my clients well, everybody wants to pay no taxes, so they want to show no income, but then they want to look good for their surety or for their bank or for their investors or whoever. It's always this tightrope, okay? And some of these opportunities I'll talk to you about give you a chance to show good financial statements for the bank, as well as then have tax returns that show a lot less income just by having a different accounting method for the taxes. And the rules changed in 2018 where a lot more companies can utilize these new tax method changes. You look like you have a question.
Well, we've seen doing accounting for in the accrual basis, but then taxing on the cash basis.
Correct.
Is
That would be one basic way. Yes, correct. And then there's other methods, completed contract method, where any jobs that are open and still in process at the end of the year, you pay no taxes on until they're done. So that can be a really good way too. And there's a number of other methods that contractors can use, but those are two probably the most common. I mean, cash basis is pretty straightforward, but you know, some contractors don't know what method they're on for taxes. They don't know. So we go to them and we say, hey, gee, you know, you could save $250,000 this year if you switch to the cash method. Well, really? Okay, I didn't know about that. So it's just always thinking about how things line up, and especially if you're growing, your receivables are getting bigger every year, or at least the last few years. You know, being on the cash basis is a great planning opportunity.
So one of the things I've seen in the cash basis is when you actually slow down and work, you start getting money coming in. If you don't have money going out, the year ends, you get a tax.
It can be painful, yes.
But on the accrual side, you'll be paying taxes on money you have not yet received.
Correct.
So it's a pain either way.
That's exactly right. No, you understand it. You understand it perfectly. Yes. Well, and during that downturn, we all remember from a number of years ago, it hammered some people. But if you're planning, if you know how much that deferral is, I mean, I've talked to contractors who have no idea that they have a $500,000 cash deferral. They have $500,000 worth of income that they haven't paid taxes on yet. And this one guy recently, he didn't have any idea. I go, do you know that you owe like $150,000 someday in the future and you don't know? And he's like, well, my accountant never told me, you know, and I'm like, okay, well, these are the kinds of things that if you plan for them and you understand the methods you're using, you can really watch those things and it's not a surprise. So, all right, depreciation. Bonus depreciation, pretty straightforward. You can deduct 100% of the cost of a piece of equipment or tools or whatever you use in your construction business, ordinary and necessary, of course, if you place it in service by the end of the year. So if you bought a fleet of trucks on December 30th and got a loan for it, you can deduct it 100% of the cost. And bonus depreciation is a little bit different, well, and it's new and used equipment, which is a little bit different than Section 179, which I'll talk about in a minute, but it's new and used. So whatever you buy, you can deduct. And we always sit down with our contractors near the end of the year, at least, and we say, gee, you know, what kind of equipment do you need in the next 6 months, 4 months? What do you need into next year? Well, it might make sense to buy it now. Pretty straightforward. And you can finance it, obviously, fully. So, you know, you buy a $100,000 piece of equipment and you take a loan on it and you don't start making payments till February, your taxes are due in April, and you're going to get a $100,000 deduction. It's going to save you $30,000 in taxes, and you might have paid $2,000 or $3,000 in loan payments. So that's a pretty good cash flow method. Now, again, you've got to understand that if you would turn around and sell that piece of equipment or dispose of it, you might have a gain. You would have a gain because you've used up that whole cost basis and you've written it off all in 1 year. So if you turn around and sold it for $60,000 the next year, you'd have a $60,000 gain. So again, just something to be aware of. Once you understand these and pay attention to those details, then none of this stuff is a surprise.
Is there a limit?
No limit. Absolutely no limit. You can buy $100 million worth of stuff. And also, bonus depreciation can put you into a loss situation in your company, tax loss. So it could give you an opportunity to offset against other income you might have. So, and again, this is going strong through 2023, so it's got 3 more years, and then it starts to phase out. But this is a huge benefit that they made semi-permanent when they changed it for 2018. Then there's Section 179. That is a little bit different than bonus, but same concept. Basically, you can write off up to $1 million worth of equipment. If you buy more than 2.5 million during the year, then it starts to phase out. But Section 179 is a little bit different in that you cannot put yourself into a loss. So there's a lot of other little detailed dynamics regarding these 2 different types of depreciation, but we generally sit down and when we do the tax return, we really look at this and figure out the best way to do this for the client, depending on what their situation is. But depreciation is a big deal. It's a big deal for contractors, and I'm sure most of you already know that. Real estate improvements. It's used to be that those qualified for Section 179. They don't anymore. So it's 39-year life for any improvements you do to your building. And we'll talk about some other ways to get deductions out of real estate here in a minute. Autos, another interesting thing. I don't know if you guys have automobiles in your businesses. Most contractors I know, probably 98% of them have trucks. Nobody seems to have cars, but if you do have cars, it's a much better deal for depreciation. It used to be that it would take forever to deduct a car in your business. Now it's quite a bit more aggressive. $10,000 the first year, $16,000 the second, and then another $9,600, and then $5,700 every year after that. So it used to be if you bought a Ferrari in your business, it would take you about 50 years to write it off. Now it's a little bit shorter time, but again, ordinary and necessary business expense. Ferrari, I don't know, but I just thought I'd throw that out there. Okay, good. And then they call a luxury auto, they call anything over, I think the IRS deemed a luxury auto being about $18,000. So yeah, anything over that. But so
That's a luxury vehicle.
that's a luxury vehicle. That's all the IRS agents can afford. So yeah, that's what they do. So again, the depreciation is $41,000 in the first 3 years as compared to $11,000 is what it used to be. So it makes a lot more sense to buy a vehicle, a car in your business if indeed you do need one. Real property depreciation. Well, this is, it takes forever to depreciate real estate, especially commercial real estate. And 39 years is a long time. So one of the things, and hopefully all of you who own your own building or your own property have thought this through, but a cost segregation study is a way to benefit from shorter depreciation lives. Now, basically what that is again, 39-year property is I think, you know, an $800,000 building is, you know, $20,000 a year for 39 years. It's like, woohoo, you know, big deduction. However, a cost segregation study would come in and basically engineers look at your plans and look at it and say, okay, 5-year property would be any electrical, okay? Any electrical in the building is 5-year property because it's hooked up to computers and light fixtures and things that are much shorter life, okay? Obviously, this cabinetry in here would be 7-year property. Everything from the lighting in the lobby to the parking lot to there's a number of different things that are much shorter life. And basically, the cost segregation studies that we do, about 20 to 30% of the cost of the real estate is able to be turned into a shorter life property. So basically, and this isn't free money. It basically just accelerates the depreciation early on and gives you a deduction sooner rather than waiting 39 years to fully depreciate your building. And you can also go back. It doesn't have to be with just a new building that you just bought this year. You could have a building you bought 10 years ago and get a cost seg study and basically recapture all that depreciation and get a huge deduction in the year that you do that study. So it's a service that CLA provides. A lot of other companies do it too, but it's kind of, if you have a building and you haven't had one of these or at least looked at one of these, you're missing out.
It was nice for that year that it did it, but boy, it hurt.
Right? Now, did you do it when the building was new?
No,
Or-
I did it 2 years after.
2 years? Okay. Well, you
But
saved,
still, it was nice.
how much did you save?
A
That you,
lot of money. but
okay, good.
I was complaining the next year when I didn't come again.
Let's get another customer. No, sorry, that doesn't work that way.
I know, that's what he said.
Just buy another building.
Oh, yeah.
There you go. But yeah, so it's just, yeah, real estate is not generally a tax advantaged investment. It's a long-term play. However, if you need some deductions, there are ways to get those. And it just basically breaks it down to shorter lots. Okay, another neat opportunity that came out in 2018, qualified opportunity zones. Now, has anybody heard of this? Okay, well, basically, it's a new law, whereas governors in a number of states, I think like 40 states, sat down and identified areas that they thought were areas that needed development, okay? They're not always blighted areas. I've got a client now that on the south shore of Kauai in the Hawaiian Islands is building a home there and bought, it's going to be a rental property, but a home for him, and it is in a qualified opportunity zone. Well, I guess 20 years ago, they had hurricanes and big storms that destroyed a lot of that area. So again, send me an email and I can send you to a link with a map that shows there's a lot of QOZs in the Salt Lake area. And basically what this means is if you have a large gain, you've got to come into this game with a gain. If you have a large capital gain and you take that money and you invest it into a qualified opportunity zone and you improve that property, you basically defer the gain for 7 years. Then you pay the tax on the gain 7 years from now, but then any growth from the time you bought it forever is tax-free. Now, it's a fairly complex play, but we've done a number of these at our offices with our clients, and they're saving a lot of money. And it's a really, really good opportunity for the right property. And the timing, again, you've got to come into it with the gain, okay? And it's like a 1031 exchange with a whole lot of different rules, okay? But really interesting. So if you have a gain or you anticipate having a gain, maybe this year you anticipate selling a piece of property, think about it, because it's a lot more flexible than a 1031. You don't have to identify the property like, 120 days later. You can take 2 years to find that new property, but it's really good. And then there's also QOZ funds that you can invest in that basically invest in these properties in these zones, and you can get those tax benefits through that too. So really interesting. Okay, business income. Well, you'll remember back in the day, up through 2017, there was a thing called domestic production activities. And there you are. Domestic production activities deduction, and it was a great deduction for contractors in that you could get a 9% deduction on your taxable income with a few constraints to it, but really good. And I still have ran into some contractors that are clients now, but weren't clients before, where their accountant had missed this deduction. So it went through 2017, so that would be 18, 19, 20. We could still go back and amend 2017 returns to get that deduction. But that was the old way. Now there's a new thing. The DPAD was repealed in 2018, and now there's what's called the Qualified Business Income Deduction, and it's a 20% deduction on all of the pass-through income that you have from your companies. Okay. Now there are restrictions and limitations there, all in caps, and we'll talk a little bit about that. But it's a fantastic deduction for contractors. Okay. It does basically. Here's the 9%. That was the DPAD. It was limited, and now the qualified business income deduction is also limited. It doesn't work for service industries. Okay. So of course, accountants, it doesn't, and athletes. And consultants don't get this deduction, darn it. I guess we didn't have the lobbying in Washington that the construction industry had. But so it's not available for service, but it is available for architects and engineers, which is interesting. Who has to do, they obviously have to do with construction. But basically, what this means is if you're an LLC owner or an S Corp shareholder, you get a straight 20% deduction of your flow through taxable income. So for example, you have $100,000 on your K1 in 2017. Well, in 2019, you would have $80,000 on your K1. You would automatically get a 20% deduction, okay? But that 20% deduction is limited to 50% of the W-2 wages that you pay in that entity. So you would have to pay at least $40,000 with the W-2 wages to get that $20,000 deduction, okay? But then you might say, okay, well, I also have an LLC that owns my building, okay? And my building doesn't have any W-2 in it because I don't have any employees in my LLC. All it does is hold the real estate and rents it to my construction company. Well, in that case, there's another way to look at the restrictions, and it's 25% of W-2 wages. Well, we have none, and 2.5% of the unadjusted basis, which is the cost basis of the property. So in that case, let's use, and qualified property is obviously a building or something that is more than 10-year cost recovery. So it wouldn't work for, you know, construction equipment, but it would work for real estate, and that's majority of what it's used for. But so 2.5% of the cost basis. So say you had $1 million building and you had, again, $100,000 worth of taxable income in your LLC that owns your building. Well, you have no W-2, but you do have $1 million, and $1 million times 2.5% is $25,000. So that allows you then, in that example, to take the $20,000 deduction. Now, if you only had a $500,000 building, then you would only get 2.5% of that, or in that case, $12,500. You would be limited to $12,500 and not the $20,000 deduction on the other side. But basically, another great opportunity for contractors. We've seen a few other accountants miss this, but most of them get it, and most of them get it right. But definitely look on your tax return, and it flows through on your personal return. So look for, and I think it's on page 3 of your personal 1040, and there's a line item called Qualified Business Income Deduction. And that should approximate 20% of the flow-through income that you have on your K1 from your business. So another great opportunity, and brand new in 2018.
Does that short you too much? I mean, you gotta pay some taxes, and you're gonna short yourself in Social Security down the way. So you've got to juggle that to make sure you're paying at least something, so you're securing your future if you ever have to rely on Social Security. And so by taking this, aren't you reducing the amount that you're then claiming as wages? So you're not. Does that make any sense?
Well, this wouldn't be wages. This is the flow through on your K1. So you're,
but it's tied to 50%
of your W-2 wages. Correct.
It could reduce your W-2 wages up to 50%.
Correct. So you'd have to weigh that, If you were the only employee in your company, you'd have to weigh that and determine whether or not it makes sense. I tend to generally not plan for Social Security. I tend to save as much tax as you can now and take that money and invest it and put it into your business.
So
So,
this is W-2 wages, not W-2 wage. It's not just your wage.
oh, it would be everybody,
It
sure.
could be everybody in your company.
So, yeah, correct.
Too,
Then you should have plenty.
offset from your K-1, so it's not just affecting, oh,
Right, right. So, but yes, so again, the limitation has to also you don't have to worry about all these restrictions if you make $315,000 or less in taxable income on your personal tax return. You don't have to worry about the 50% W-2 restriction. So keep that in mind too. And then, okay, so to change gears a little bit, meals and entertainment, that went away. There is no more deduction at all for Jazz tickets and or Kansas City Chiefs tickets or whatever tickets you like to have, golf tournaments, things like that. So business meals are still 50% deductible. So a lot of people, I know I have a client that has a box at the Jazz Arena, and he's worked with them to have them allocate more of the cost to food and beverage. You know, I thought this, when this came out in 2008,
Turkeys.
I thought, yeah, they get like caviar and champagne every time, right? But no, I thought this would really devastate the sporting industry, and it really didn't seem to affect them that much. I was, because, you know, all those boxes, I mean, those cost a lot of money, and companies pay a lot of money, and if you can't deduct any of it, that's pretty tough. But yeah, it doesn't seem to have affected the Jazz and other professional teams. So
Depends on how they're playing as well.
yeah, right, of course,
Jazz have sold out 90 games straight
right,
at home.
right. Well, I'm a Denver Broncos fan, so I have my own issues with that. Yes, and they still sell out, but yeah, right.
they might try basketball.
Yeah, what's that?
They might try basketball.
Yeah, right. There you go. But so again, business meals, 50% deductible, includes employee per diem meals, and meals for the convenience of the employer are fully deductible. So if you bring lunch in and have a meeting or something that's business oriented, then that would be 100% deductible. So again, I'd be glad to talk to you about some of the details of that, but it does make sense to break out your business meals and entertainment and stuff like that in different accounts, so that at the end of the year you're not going, well, what did I do here? And because it's a little more, you have to be a little more precise these days. Big deal. Okay, here's where we were talking about the change in tax method. Now, this may not apply to all of you, but it applied to a lot of our clients. It used to be that the limit for switching to the cash basis of accounting for taxes or the completed contract method, which again were the two most popular alternate methods that we used with our contractors, the limit was $10 million in revenue. So if you went over $10 million in revenue, you had to switch to the accrual basis, okay? Which was like, okay, great, so much for that advantage. They now changed this to be up to 25 million. So we happen to have a whole lot of clients between 10 and 25 million that took advantage of this, and we switched them. I mean, we probably switched 15 or 20 clients to that method. And we kind of looked at it. I mentioned here the hybrid method, and there's really like a cash completed contract, and we basically had to figure out what would work best. And it turns out there's a hybrid of the two, cash and completed contract, that worked for most of the ones we switched. That one worked best. So it might be something you might want to mention to your accountant, or give me a call. I'd be glad to look at it with you. It's just a tremendous opportunity. And, you know, again, nobody wants to pay taxes now. they don't like to pay taxes in the future, but they'd rather pay them in the future than paying them now. And this is a great opportunity, especially when, you know, times are good and hopefully you're making a lot of money. Hopefully you're in a high tax bracket, and this kind of stuff, it's like, wouldn't you rather have the money and do something with it to expand your business, or put it away in a profit sharing plan, or do something to save your taxes now? Much rather have pay it in the future. So some great opportunities here. C corporations, lowered the tax rate for C corps to 21%. You might be saying, why am I bringing nobody's 21%? I mean, we did about 90 continuing education classes for the AGC this last year, and with an average of 50 to 80 people per class. And I would always ask, how many people are C corps? And probably one or two, maybe, in the whole group of 50 to 80 were still C corps, okay? So it's completely gone away. I mean, back when I started, we had a lot of C corps still. But now it does make sense under certain circumstances to be a C corp. And what would those circumstances be? Well, the tax rate is very similar to what it is. If you look, again, a C corp at 21% is tremendous. That's obviously a lot less than the individual rate, but it only happens at the end when you close your company and you get the money out of your C corp. Well, you have to pay dividend rate of 15%. So that's where it comes back to get you. That's why it's called double taxation, okay? But the double part doesn't happen until you're done, or until you sell the business or something like that. But if you have a company, and we've got a few clients that decided to do this, if you've got a company that you're going to keep all the money in the company and you're going to grow it, and you're really, really going to grow it, you might consider a C corp, because again, the tax rate is really low. So it's an interesting, in the right, I mean, like I said, we probably did 3 or 4 of these out of many hundreds, but it still might make sense to think about it. And if you have maybe a special purpose entity that does something special, that you want to keep the money in it and not take it out, then that might be an option for you. Gift and estate taxes, 40% over 5.5 million it used to be. Now it's up to 11, but I know they're continuing to talk about this and hit the ball around on the tennis court there in Washington about changing this, and depending on what happens with the election, and if not this election, the election in 4 years, you know, are they going to ramp this back? You know, we have a number of clients that we're doing a lot of estate planning for, and there's some opportunities to protect that $11 million exemption, even if they do change the law in the future. So just, again, something to be aware of. Individual taxes, well, here you go. What's your status? Okay, very funny. Check your form this year, see if that's on there. Tax rates overall went down a lot, from 2 to 3% overall for every bracket. So that's good for everybody. Everybody's taxes hopefully were lower in 2018 than they were in 2017 just because of this. And one of the things that we always plan for is tax bracket. You always want to try and be in the lowest tax bracket that you can. And one of the things that we do, whether it's with method changes, whether it's with profit sharing plan contributions, whether it's with buying equipment, we always try and plan to get you in the lowest tax bracket possible. Capital gains rates didn't change. Another thing, if you have, I know we've got a number of clients that maybe don't make more than $77,000 as a married couple, usually retired people, and if they have capital gains, they pay 0 tax on their capital gains if they're married filing joint and they're under $77,000 worth of taxable income. Something to think about. We always try and dial in many of our retirees to take some gains to get them under, just barely under that $77,000 every year. And don't forget the net investment income tax. which is another 3.8% on top of the 20% or 15% capital gains rate on investments. If your adjusted gross income is over 250,000, you get a bonus, 2.8% or 3.8% tax on top of it. So it's really 23.8 or 18.8 capital gains rate. And same with dividends as another 3.8% also, and interest. Standard deduction changed. So if you're hurrying to put all your receipts together to come up with charitable contributions and state income taxes and mortgage interest, if it's under $24,000 as a married filing joint person, don't waste your time, because you're automatically going to get that $24,000 deduction. So keep that in mind. We've got clients that bring us all these receipts and all this stuff. I'm like, you don't have to do that. You know, you only have $20,000 worth of quote unquote itemized deductions, so it's not going to help you. Something to think about. And this kind of changes some of your other planning here I'll talk to you about in a minute.
Is this one of the, we wrote back in 4 or 5 years?
No, I believe this is permanent. This is permanent. Whatever permanent is in Washington. I mean, I don't know.
I don't know if it's
How
not
much
back.
storage?
I mean, permanent in that it's not scheduled to change.
Right.
Child's tax credit, a lot more people can get this now. It used to be things would phase out. Now it doesn't phase out until $400,000 in taxable income. So a lot more people are getting a child tax credit. Individual deductions, state and local taxes. This is where the people in New Jersey and California and New York are very upset, because they used to be able to deduct on their personal return as an itemized deduction the state taxes that they pay. And state taxes are a lot higher in New Jersey than they are in Utah, okay? We pay less than 5%. I think New Jersey goes up to 11%. Hawaii goes up to 14%. California is 13.8 is the highest rate. So it's a lot higher. So they're paying a whole lot of state taxes. And guess what? They can only deduct $10,000 in state taxes. I got a client that paid over $300,000 in Utah state taxes, and he could deduct $10,000. So yes, it's kind of a pain, but you know, they gave us some things, but then they took some other things away, and this is definitely one of them that they took away. Mortgage interest used to be 1.1 million. Now it's 750,000. No longer can you deduct a home equity loan interest. You cannot deduct that anymore, just to let you know. That surprised a number of our clients last year. But you can get interest on a second home. Or you can refinance your home because you got a lot of equity, and you can take up to $750,000 worth of loan interest on that. So just something to think about. Charitable contributions was up to 50% of your income. Now it's up to 60%. But because of the standard deduction being $24,000 for a married couple, it might make sense for you to skip a year with your tithing or any major charitable contribution you have and double it up on 1 year so that you get the deduction. Because you're automatically going to get the $24,000 if that puts you over by doubling up your charitable contributions. That might be something to think
I
about.
still maintain a temper recommend if I do that.
I think so. I think that I could work with you. I'll write a letter or something. You know, I'll help you.
No.
No. No, what you do it on December 31st, and then you do it on January 1st. You know, it's fine, and everybody's happy. You know, you don't spread it out over the whole year, and they'll be happy. They can take the time value of my so, individual alimony, another thing. If you happen to get divorced, alimony is no longer deductible or taxable to the recipient or deductible to the payer.
I picked the wrong year.
Yeah, right. And also, one other thing, you know, I think you all know about, we do our wage and benefit survey every year. We've delayed it a little bit this year. It's going to be coming this summer. So look for an email from us to fill it out. It takes maybe 20 or 30 minutes to fill it out. It's a fantastic piece of information with all of the wages of all the trades. I think we have about 35 different trades with specific average pay. We had about 200 and something Utah contractors that participated in this last year. Hopefully we'll get at least that many this year. So it's a really good sample of.
You do the data just for Utah and the rest of the country?
No, we do it just for Utah. It's something we've done. It's something the Leverage Group has done, and CLA has supported us with this. Yep, it's just a Utah thing. They should probably do it nationally for some of their other offices, but you don't care what they're paying in California or Michigan or whatever. But
And if you participate in this, then you get the survey.
then you get a copy right out of the gate, right? You don't have to wait. And this is a tremendous, tremendous value. So look for it this summer. We're a little bit delayed this year, but look for it this summer.
Is that because we were delayed getting it to you?
No.
Okay, does anybody have any questions?
Any questions?
On the flip side there, just unmute your.
Everybody left.
Anybody?
I guess they don't pay taxes down in St. George, I heard. You don't have to pay taxes, I heard. Maybe not.
I had a group of employees that got a hold of this information that you published.
Uh-oh.
And they came into the office and said, what are we paying the secretary? We're overpaying her. Oh, are you
Nice.
kidding me? You're gonna tell me how to run my business?
Nice, right? Oh,
I
ouch.
think we're not gonna have the conversation.
Yeah, right. Well, I know some people definitely got upset that they were, their CFO or their controller got a hold of this. They go, what's this average? It's average, well, I need a raise. Well, I mean, you can do that anywhere. You can go on Robert Half, and you can go on any of these websites that have comparable wages, and many of those are really inflated because they're also executive search companies that want people to think, oh, I'm underpaid. I want to hire these guys to help me find another job. So it's hard to get good information. I mean, again, ours is pretty good, I think, because it's a couple hundred Utah contractors, and they would have no reason to not answer honestly. But yeah, it's good. Well, you guys, owners, get it first. I can't be responsible for who ends up running.
Shredded it.
Yeah, right.
Hey, Dave or Steve,
A survey.
this is Jeff Ty.
Okay, go ahead, Jim.
Hello, Jeff. Hi.
Can we get copies of your slide presentation there for us that aren't sitting at the table?
Yes.
Tomorrow.
Yes,
We'll
you
be
can. You know what
sending
I'll
out a
do?
link So you can watch the entire program again, and I'll include a link to the PowerPoint.
Yeah. That's
Okay,
terrific.
sounds good.
You're welcome to it. What are you doing down there?
Living.
Okay, good.
I'm
Nice.
golfing.
Did you play golf today? That's what I was going to ask.
Yes, I did.
That's great. Good for you.
He keeps track every day.
Does he? And he
Thank you.
runs it. Okay. Nobody here played golf. So
Hey, wait a second, I played today.
Oh, you did?
Yeah,
Nice.
West
We're out.
Boswell's open. It was awfully muddy. So you didn't have to worry about your ball this time though, running.
You gotta stay on the green. Not as much.
It was.
Any other questions out there? If not, thank you very much, Steve.
All right. You're welcome.
We
Thank you.
appreciate it
Thank
very
you.
much.